The 15-year mortgage. This is the I'm taking my financial goals extra serious option. This is for people that want to expedite getting their mortgage paid off and really focus on being debt free, including mortgage free. So, the thing about this option is that you're actually foregoing tapping into your equity, foregoing trying to get the lowest mortgage payment. You're actually taking a higher mortgage payment in exchange to get mortgage free sooner. This option takes some serious commitment. They all do, but this one really does. So let's go through a scenario. Let's say you got your original loan at $300,000 on a 30-year fixed rate mortgage at a 6.75% interest rate. Your monthly payment, just the principal and interest portion of your payment, not including any property taxes, home insurance, or PMI, is $19.45 a month. 3 years later, you would have about 27 years remaining on your loan, and your loan balance would be $289,725, assuming you've made minimum payments for the last 3 years on this mortgage. Now, let's say you wanted to look at a refinance to a 15-year mortgage. Your new loan amount roughly would be about $299,000, 15-year fixed rate mortgage at 5.5%. Your new mortgage payment would come out to about $2,443 a month. This also excludes the property taxes, home insurance, and PMI, just so we're comparing apples to apples with the principal and interest portion of the payment. And the benefit in this option is you'd be mortgage free in 15 years, shaving quite a bit of time off your mortgage. Now, you are jumping into a higher mortgage payment there, so that might be something that someone would be uncomfortable with. A great strategy for someone that maybe doesn't want to make the leap into a 15-year mortgage is to start paying extra on their mortgage. Let's take a look real quick and see how much that might benefit them if they chose to do that versus refinance to a 15-year. We're going to look at payoff horizon and interest paid. Basically, if let's say you did not refinance to a 15-year mortgage, you kept the loan that you have, and you're 3 years into your mortgage and you decide that you want to get serious about getting mortgage free in the future, you start making an extra payment of $497 a month towards principal reduction, basically making that 15-year mortgage payment on the mortgage that you have in place. So bringing the total payment to the amount that the 15-year mortgage payment was. This is still a huge benefit, and it's going to save you a ton of money over the course of your loan. If you did this, your mortgage would be paid off in about 16 and a half years, so shaving a ton of time off of your mortgage if you made that principal reduction payment each month. Total interest that would be paid if you did that at that point in time would be about $189,000 for the remaining duration of that mortgage. Now, real quick on the 15-year mortgage, let's say that you chose to refinance to the 15-year mortgage. That interest rate is lower, so there is going to be some additional savings there as far as total interest. So you would have the loan paid off in 15 years, so about a year and a half sooner. And the total interest in that scenario is about $140,000. So you're saving $49,000 roughly in interest if you refinance to the 15-year mortgage versus paying extra on the mortgage you have. That's not to be said that a 15-year mortgage is for everybody. It's totally not. But this still does demonstrate how much you can expedite your mortgage payoff if you paid extra on your mortgage per month versus, and especially for people who aren't comfortable jumping into that 15-year mortgage, making that extra payment a month towards the principal, even if it's a smaller amount, will make a dent in your interest savings and help expedite your mortgage